Well, good morning again, everyone. Thank you for being here. My name is Juanetta Ayers. I'm Executive Director for Commonwealth North. It's a pleasure to welcome you here this morning. Normally we have luncheon events. Believe me, I did hear from a few members who wanted to be here this morning but said no to a 7:30 start time. So we're happy to have you here and appreciate your interest in today's topic. Whether you're here in person or watching the recorded program later, we thank you for your time and your attention to this important topic. I want to start with a few acknowledgments before I introduce one of our board members. First of all, we acknowledge that we're here on the Dena'ina Athabascan traditional homelands and that Alaska is a homeland for 228 federally recognized Alaska Native tribes. I also want to acknowledge our volunteer registrar, Margaret King, who checked you in today. And she's been a real stalwart, along with Carol Anderson, who couldn't be with us here this morning. And we want to acknowledge our sponsors. We're very appreciative of Alaska Communications and ConocoPhillips Alaska, who have been our program sponsors throughout 2024. So if you would please join me in acknowledging our volunteer and our sponsors for their support this morning. And again, thank you, and thanks to our members and board members who are present today. We appreciate your support. So let me introduce Cheryl, although she did introduce herself, but I want to bring her up to the lectern in a moment, but let me introduce her for those of you who may not be familiar with her. It's kind of hard to imagine that you're not familiar with Cheryl, but Cheryl is, we'll come up and introduce Deven more formally, but Cheryl is an inveterate champion of sustainable fiscal policy. She served the Murkowski administration as state O&B director, and she holds a triple crown with the municipality of Anchorage, having served the Wirch, Sullivan, and Bronson administrations. She is a much sought after campaign guru for ballot measures and candidates. And earlier this year, the Alaska State Chamber of Commerce recognized Cheryl for her 40-year career and commitment to sound fiscal policy and public service, giving her the Ted Stevens Public Service Award. She's a current board member of Commonwealth North and an emeritus president, and it's kind of like the mafia, she can never fully get out, and she is the longtime co-chair of the Fiscal Policy Study Group. When she pretends to retire, she is a very successful entrepreneur combining her dual interests in artistic beading and international travel. So please help me welcome to the lectern Cheryl Frasca. Cheryl?
Yeah, just saying. You know, I'm that old. So good morning, everybody. It really is nice to see folks in person at a subject matter that is extremely important to Alaska's fiscal future. And so my job today is to introduce Deven. And as I'm sure everyone in this room knows already, that he is the CEO, as he said, of the Permanent Fund Corporation. And we all appreciate what the role of the Permanent Fund is in terms of our state's finances. Deven assumed his new role in October of 2022, and I think since then we've all learned a lot more about the governance of the Permanent Fund through various sources. Prior to that, though, Deven served as a debt manager for the state of Alaska, as well as the executive director of the Alaska Municipal Bond Bank. And over the years, I had the opportunity to work with Deven on various issues associated with those roles that he had. Always well-respected, solid, gave you the facts, the information you needed, which was always appreciated. And so we invited Deven to come. The Permanent Fund Board just had its meeting, right, annual meeting, the last couple of days here in Anchorage. And the interest that at least I had in Deven coming today was to talk about the trustee paper number 10, and which is about the endowment model or the structure of the fund itself, in terms of going forward, given its incredible role in the state's finances in providing revenue to pay for state services, as well as a dividend. So please join me this morning in welcoming Deven, and appreciate your expertise that you're sharing with us today.
Thanks, Cheryl. So I think I've served under 7 governors, so I do maybe have Cheryl beat on that.
Yeah, but I have a lot of legislators.
Never mind. So looking around the room, I mean, it's a little more intimidating than your average audience because of the quality of audience this represents. There's a lot of folks that I've worked with throughout my career, and respect each of you as an expert and someone that I would classify as generally being policy aware. And so if I appreciate the question on the trustee paper, because it is important to me to be able to tailor message to the needs of an audience, and even in my I had some chat while we were starting, and it's easy to have a variety of viewpoints on the permanent fund because it is so polarizing, and there's a long history of evolution from and it's also interesting if you look back in time. I know I used to sometimes interact with Sterling Gallagher, and Sterling would claim that he created the permanent fund. There is a lot of people that claim they created the permanent fund, but it really was a group effort, and just an extraordinary thing in my view that any group of people would be willing to give something up, not for themselves, but for the future. And that's really, to me, the essence of what the permanent fund represents. Is like probably the most respected part of human nature, when you're willing to be altruistic and say that I'm going to forego that additional widget so that my children and the future generations of this state will be able to benefit in a similar fashion to that which we have while we live in this state. So the constitutional amendment that was approved in 1976 is on this slide. It really didn't create a fund that was for the purpose, any purpose. It wasn't for a dividend, it wasn't for capital projects, it was really just a means of saving money, and that was part of the genius, because the same political differences that you might have today on how to use the fund existed back in the 70s as well. And so they said, well, okay, we can't agree necessarily on whether it's going to be a public trust or a development fund or what it is, but we should save some money because we just went through $1 billion when we had a budget of 150 million. So today that'd be like 30 or $40 billion showed up out of the blue. We would be, woohoo, we're rich. And then 8 years later, it's gone. And so it's easy to spend money, and people recognized that and decided that they would save a portion of revenue. And of course, the primary fund source is the North Slope and oil royalty revenue. There's some from mining and other activities, but that's really, I mean, I think it was $2 million out of $400 million that was deposited into the fund last year in ballpark terms. So, not knowing your question in advance, we were going to talk a little bit just about performance and then talk about trustee paper 10. I know performance has been talked about lately. The stock market's been going crazy. Well, really, the stock market, the S&P 500, hasn't been going that crazy, but 7 stocks have been going really crazy. And so we just talked about it yesterday. There's been a view in our public equity portfolio director's mind that growth is exuberant and is representative of a bubble, and he's had a value proposition on, so low volatility value stocks, which has resulted in our performance suffering relative to just a broad S&P 500 exposure. And certainly if you own NVIDIA, well, good on you, you've been killing it. But the asset allocation of the fund isn't designed to try to hit home runs with NVIDIA. It's designed to provide as stable a return as possible, and the target isn't 30%, it's CPI plus 5. So inflation plus 5%, which any institutional investor will tell you is a very difficult target to hit consistently year after year after year through time. And in fact, if you listen to our board meeting, some of our advisors suggest that that's too high of a target. I don't know that that's right or not, but it's certainly a hard target to hit. You can see the progression of the portfolio from 1980 to 2006 to today. We were all fixed income at the beginning, maybe in the golden age of fixed income, because interest rates were so high in the 80s that the fund really benefited from that asset allocation. And then the diversification that occurred has really increased volatility, which is an indicator of risk, and that's been required to try to chase that rate of return. And so the more risk you have, the more volatility, the more cushion that you need to have in your structure to provide for a regular and recurring transfer to, in this case, the state of Alaska. This slide, this part of the slide over here, I used to love that when I was working in debt, just because we talk to rating agencies a lot and they look at our economy and go, look at this small economy, 50 billion, 60 billion in GDP, it's insignificant. And I'd say, well, it's not really just Alaska that generates money for the state of Alaska. This thing is the world's economy that generates money for the state of Alaska. And when people think about the permanent fund, I would suggest that you think about it as the money source, not the means of funding, investing to provide for the needs of the state. That's the development fund angle, and it's, I think recent history has showed that there's a lot of pitfalls in trying to pursue that. It's a small state. We do have a small economy. Everybody is interconnected, and there's a lot of potential for the perception of conflict or not being able to achieve the level of quality that you want in an investment decision just because of the lack of options. This shows the difficulty in hitting that target. The dots going across that chart are historical 10-year look-backs of the targeted rate of return, CPI plus 5, and you can see that the great financial crisis created a big trough there in the middle. We didn't hit that target for about a decade. We're right on top of it right now from a 10-year look-back. So these are the last 10 years average rates of return compared to the target of CPI plus 5. And it just highlights that you have to have a very long and consistent investment strategy, and when you're not hitting the target, you need to stay the course in anticipation of hitting the target. And when you're exceeding the target, you don't want to be exuberant and start deviating from your structure, meaning in our case, drawing more out of the fund than what might be sustainable. And a lot of this presentation is really designed about that sustainability factor, that intergenerational promise, like why when I was a kid didn't we have an extra whatever? Why did I use, when I was in grade school, bill, when the legislature back in the day, and they still do this, they print off proposed amendments to bills, and there's just stacks of paper that are provided to interested parties and legislators, and then that version is modified, it's garbage. So at my school, that was our scratch paper. So we would use that to draw pictures and whatever. I mean, we could have had nice new paper, colors maybe, I don't know. But everybody gave something up to allow this fund to exist, and it's, I think, to me, that's again recognizing that sacrifice, and that this money isn't here for you to use, it's here for you to benefit from while you're here. And then the next person's going to benefit from it, or your children are going to benefit from it. This shows the benchmark performance, and that, so there's three different things we look at. We look at the passive index, then we have a performance benchmark, and that's what our managers are targeting, and then we have the real return objective of CPI plus 5. And you can see that it's difficult to hit. We're not hitting on the 1 year for FY24. We're about 7 basis points under the CPI plus 5. The passive benchmark in the 1 year, that's like I said earlier, those growth stocks and the S&P 500 are killing it. And so we underperformed on the 1 year, a passive strategy, on a significant basis. And we also underachieved our benchmark because of a combination of private equity and how many of you are familiar with private equity? It's an obscure thing for most people. They're like, what is private equity? Private equity is where we are not going out and looking to buy companies. We don't do direct private equity. We work with primarily an advisory firm that then identifies managers, so general partners that have a strategy for acquiring private companies, and their strategies where companies make things, there's strategies where geographic locations involved, there's strategies that are looking at leverage relative to equity within a certain company and inefficiencies. And so that we commit to deploy money to that partner, that general partner. Then over the course of the next 3 to 5 years, they identify opportunities for acquisitions of companies. They draw money from us. So that commitment is made, then the money goes out the door over the next 3 to 5 years as they find these opportunities. Then they work their magic on those opportunities for 3 to 5 years. And if it doesn't work out, maybe 10 years, is what it seems like. That's a skeptical comment for those of you that are in the know. And then they exit the strategies, and that's when we get our money back, and that's when the return is realized. So they're very long-lived, illiquid strategies. They might be valued at $1. You say, okay, well, I want to sell it. Well, it's really only worth 80 cents because nobody wants to buy it at $1, even though it's valued at $1. So it is, that's a, private equity is an interesting asset class, but right now we're experiencing some negative impact from decisions that were made 5 or more years ago in that particular portfolio. And the combination of those things resulted in us not hitting the performance benchmark. And then on the 3-year, you can see that we are right 1 basis point above the performance benchmark. We're a couple of % above the passive, but we are nowhere near the CPI plus 5. 2022 in particular, the fund had a negative 1.2 performance, which was good. It was above our benchmarks. I mean, we beat our benchmarks. The passive that year was negative like 10%, but yet we had to pay out 5%, and inflation was 7%. So you're 12% behind. Plus, you lost 1%, so you're 13% behind in 1 year, and that's how quickly it can happen. And then the 10-year, again, you can see that our performance is strong relative to the 2 benchmarks, but still lagging the CPI plus 5 by a few basis points. And it's not, on the very long term, we're not beating the performance benchmark, but are ahead of the real return objective. And so I think we're on the ragged edge of what an institutional portfolio can provide. And this is just kind of the same thing, but it's getting into the difference between total return and realized return, which we kind of hammer on a little bit because this is part of the structural issue. Our structure was set up, so that constitutional amendment just says earnings are available for the state to spend, and then there's a statutory framework that's built around that. And in the statutory framework, it says that we're able to, or money that earnings that have been realized transfer over to the earnings reserve account, and they're available for appropriation by the legislature. And so that asset allocation that we have and that private equity, those private market type exposures, results in what are called unrealized gains. So as something goes up in value, and you really could sell it or not, but assuming you can really sell it, that difference between what you bought it for and what it's worth is an unrealized gain. And some people are like, yeah, well, you didn't realize it yet, so it's not real money. Well, none of this is real money until you sell the stuff. I mean, if it's a public market, if it loses 10% tomorrow, it lost 10%. That's just the way it is. I mean, but it is real money. You earned it. It's just like if your house, you bought it at $10,000, and now it's $100,000. Well, if you went to sell it for, you really can get it $100, you get $90,000. Did you earn that in one day? No, you earned it over the lifetime that you lived in that home. And so total return is the blue line going across, and you can see it's more volatile. It has wider swings up and down, but on average, it's above the gold line, which is realized return, because our portfolio has around $14 billion of unrealized gains in it at this point. And so that in my view, is one of the significant contributors to the structural issue that challenges us right now, because that $14 billion of historical earnings is not available to spend. It's just, we allocate it around and it sloshes between the ERA and the principal, but you can't actually spend it at this point. Although we did have an interesting question the other day at the board meeting about whether or not you could appropriate unrealized earnings as inflation proofing to the principal. And I don't know the answer to that yet, but it's kind of interesting. This is projecting, it shows you the historical statutory net income, and like this right here, that's the doomsday scenario right now. If that were to happen right now, we'd be in the legislature would need to act in short order, because there would be an inability to provide for the percent of market value transfer to the state of Alaska. And this, so as we've gone through time, there's been an escalation, and really over the last, I don't know, 10 years, this is kind of exacerbated, but there's been a war chest of unrealized gains made, which is accounting income, like I said earlier, and we've had a declining available balance in the earnings reserve account, and so those are correlated, those two things. At the end of last fiscal year, not last fiscal year, the one before that, 2023, we had about a $200 million balance in the earnings reserve account after you provide for the POMV of the current year, the inflation proofing of the current year, and then the projected, now known POMV of the coming year that the legislature will be budgeting. This year, at June 30, so the end of FY24, we actually had a negative balance for the first time. So there was a negative $400 million balance in the ERA when you said, okay, we want to provide for 2025, the current fiscal year's POMV transfer, 2025's inflation proofing, which is under appropriated, by the way, it's $1 billion. And then the coming year, 2026, is POMV. So it's conservative. I think everybody acknowledges that's a conservative structure, but it maybe is appropriate that you want to be able to say, we've got the money to pay for the coming year's POMV. And we didn't at June 30. And if this year turns into that year, again, that's where you're like, but we're just not prepared for it. We're not prepared for that right now. I mean, if you had those 2002 to 2003 years, again, you would be struggling, because what starts to happen is you're like, oh, well, we'll earn that money this year. And then if you don't earn it this year, you could theoretically earn it the following year. But if you have 22 and 23, well, you're not going to earn the money, and you're not going to have money available to appropriate that's essential, not just for a permanent fund dividend distribution, but for schools and whatever other public safety things that people think are important. There's probably other things you don't think are important the state pays for, but I won't mention those. So the transfers to the state, I think this is also a big issue, that these outlier years of 2021 and 2018 on statutory net income kind of elevate that average. But if we have a POMV that's $3.8 billion, and then inflation proofing, and if inflation's running 2.5%, you're like 1.5 billion. And so you go, okay, well, you're 5.2 billion-ish that you need to make to hit your targets. And you can see a lot of these years we're not hitting that target on a statutory net income. On GAAP income, it's actually a little closer, but it's going to have that volatility baked in. And so on a GAAP income basis, we're going to be we're closer to hitting the target, but the cushion would need to be a little bit bigger as far as like a balance in an ERA or a fund that would be available from historical earnings. And if you just went to a true POMV payout with an endowment model, you wouldn't have to worry about any of that. It would just be automatic. So inflation proofing would be automatic, because you would have a limited draw that would be based on a historical average balance. And at that point, all of this noise that we're talking about today wouldn't exist. It would just be a matter of, is the POMV payout right-sized for a sustainable drop that's going to exist in perpetuity. And this kind of goes into that unrealized gains, so dividends on stocks, interest income on bonds, rents on property, and then the capital gains when something's sold. Those are realized. The unrealized are the increases in values of things. And so Tyson's Corner, which is an amazing facility, I was actually able to go review that property with our partner. We have a partner that owns 51% of that with us and our manager. And yeah, malls, I thought they were dying, but not that one. It's a great property. And it's got 2 office towers and a hotel and a residential tower co-located, and it's just a vibrant place, which was great to see and experience. How just stuff you don't think about, you know, oh, that retailer, they're doing okay, but they're not the hype retailer, so we're going to move them over here. I mean, stuff that you just don't think about as far as how you manage a mall to maintain the excitement about going to a mall, so that it doesn't become one that nobody's seeing. But $559 million in unrealized gains. Those gains, like I said, they've been between here and 1985 gradually earned, but you can't spend them the way that we're currently constructed unless you sold the asset, which isn't something that we want to do right now. This shows you where earnings have come from, realized earnings historically, and you can see the majority come from public equity. That's a liquid asset class, and there's been some good years, and as there's increases in public equities, then we have a target allocation, so we trim from that, and that generates income, statutory net income. The negative bars down here is fixed income, and that's a result of interest rates. When interest rates go up, fixed income securities diminish in value, but at the same time, you say, oh, well, that's kind of a dog of an investment. The fixed income asset, the allocation has provided the opportunity to reallocate during markets where there's been dislocation. And so it's another liquid asset class that's it's kind of the foundation of your asset allocation, so that when you need to have money, it's always going to be there. And when you need, from a liquidity perspective, and when other assets classes, they tend to operate countercyclically, and so when other asset classes are going down, it tends to be a little more stable. And this just shows that same thing in another format, unrealized gains. I guess this is the actual where gains have occurred. So this isn't statutory net income, it's just gains, and you can see that again, stocks has been the primary generator of statutory or unrealized gains. I'm sorry, I'm misspeaking. So this is the 14 billion that I referenced earlier, and you can see from just 22 it went from 11 to 14. So when I said we've had this negative impact on the earnings reserve account balance, that would have been a little different story if these earnings of the last couple of years were included in the equation. And this is statutory net income, and it's an interesting pivot point where the amount saved for future generations and the amount paid out to the current and past generations are the same. It's just, I mean, Paul and I won't say geeked out, but found this to be a fun slide. And it shows you where the earnings have gone, and this 87.8 doesn't include that 14 billion. So over the life of the permanent fund, you've had over $100 billion of earnings in total, and those have been 43.9 billion plus the 14 really at this point. I mean, because it's still in the fund, are available for future generations. And 43. Sorry, that messes up the math, doesn't it? And 43.9 has been paid out. The other thing that's interesting is dividend appropriations through FY18, which is when the new POMV statute went into effect, were 24.4 million, and then the POMV distributions since are 19 billion, so quickly catching up. And the use of the permanent fund as a resource, because prior to that, we had a formula based on earnings of the fund, 21% of the last 5 years' earnings, still in statute, but we don't follow it at this point. But each time the state considered how to use those earnings, it paid a dividend with half of them, a permanent fund dividend to the residents of the state, and the other half went back into the permanent fund. So the reason the permanent fund's the size it is because the elected officials of this state saved that money. And there's other examples of that throughout time where there's been special appropriations to principal, both from the general fund as well as from the earnings reserve account, as well as the inflation proofing. Yeah, I don't like that slide. The revenue stability, I think, again, this is such a positive credit story for a state like ours, where our historical revenue has been so volatile that you look at the peaks of the 2008 era when the price of oil went to what, 150 for a short period of time, and all of that volatility is significantly smooth when we went to a percent of market value payout from the permanent fund. This is how projections always look. If you look at, they're always upward ascending. If you look at the revenue sources book, this is what oil looks like too. Dan did it when he was there. But it's, the reality is it's gonna be that. It's gonna be this very choppy revenue. And this is actually the reality, that it is gonna be very smooth, predictable revenue into the future. And hopefully petroleum revenue does go up. Inflation proofing, and this is just, so prior to 2016, the state, there's a statutory formula for inflation proofing, and so the legislature would appropriate based on the statutory formula. So it would be an amount that would be calculated at the end of the fiscal year and deposited into the fund. That was an extraordinary time that we were in the late teens there, where the price of oil, I mean, in some places went negative for a period of time. And as, I don't know, the lowest spot price I saw was like in the low 20s, but the state went from an average price in the prior two fiscal years of 106 to something in the 30s. And so there was an incredible need. The CBR was being taxed at a significant rate that was unsustainable on any kind of long-term basis, even though it had, you know, $16 billion in it at one point. And so people forewent inflation proofing. They made hard decisions. The dividend was diminished in that time frame too. It was a hard decision because it was hard times. But that structured and consistent appropriation of money to offset the impacts of inflation is absolutely required to ensure that this fund is going to maintain its buying power into the future. And you can see that discipline hasn't really returned since that time. And again, it's hard. It's when I listen to elected officials, I don't know when the good times are coming back, but it seems like it's always in the future. Because times are always tough today. And so it is difficult. And when you add it all up over this time frame, this 10-year time frame, 70 years, we didn't follow the formula or appropriate a sufficient amount to meet the statutory inflation proofing, but we made some extraordinary makeups in 20. And then there's been a lot of discussion about this $4 billion in, I know Brad Keithley writes about it a lot and suggests that should be included as inflation proofing. Well, I guess if that's what you think you should do, well, there's another $11 billion out there of special appropriations the legislature made. Are those inflation proofing too? I mean, I'm playing devil's advocate a little bit. The legislature did what the legislature did. This wasn't appropriated for inflation proofing. And if you think it should have been, well, I get it. I mean, it changes this number from being a deficit to being $2.2 billion more than needed to be appropriated. But there's been different reasons that money's been appropriated to the fund for inflation proofing, and then to grow the fund because of a recognition that we hope that our state continues to thrive and that we want to be able to take care of the needs of a broader population. So I don't know, that's just, I don't know the right answer to that, but observationally, we're either $1.8 billion underfunded on inflation proofing or $2.2 billion overfunded, depending on your viewpoint. A strict reading of the statutes and the language and the legislative intent would suggest this is correct. The total value of the fund, and there's a lot of different values that you see, like assets under management at our meeting this week are 83 billion, but that's not accounting 83 billion, that's just AUM based on a day in the life of the fund, and it also includes the mental health trust money, as well as the power cost equalization money. So it's not all the Alaska Permanent Fund, but 79.1 billion. And this is intended to highlight how the earnings reserve account is committed. So 6.7 billion in the earnings reserve account sounds like a lot. What's the problem? Well, 3.8 billion for 26, a billion for inflation proofing, and the unrealized gains that are included in the ERA balance, they're pro rata allocated between principal and the ERA. So as the ERA balance goes down, they just disappear. It's just a false balance. It's not actually part of the amount that's spendable. So this $1.3 billion in gains just shifts over to principal as you spend down. And so we like I said, we wound up with a deficiency on our ability to provide for all of those things. That's since been made up. We had a very strong July and August. No, it's not all bad. We had about $1 billion of realized gains during that time frame, with which, if that pace were to keep up, we'd have $6 billion this year. It'd be an extraordinary year, and we could not worry about it for another year. But that hasn't been our recent experience. This shows where principal growth, how it's represented. So the unrealized gains, you can see in 2025 today, 13.9 billion. The special appropriations, that's the 15 billion, and where I came up with that other 11 billion that you could argue could be considered inflation proofing. It wasn't intended as inflation proofing. It was intended, I'm sure if you went and asked former Senator Halford, did he, in it's like 1987, take the balance of the ERA and appropriate it to principal as part of a group, obviously, because they wanted to do inflation proof, or because they just wanted to grow the fund. I think he would say grow the fund. Not that that makes it always right, but that would be his perspective. And he was actually there. I was there, but not paying attention. I don't know. In high school, I was not paying attention much to this kind of stuff. So you can see the special appropriations, the inflation proofing, and then the mineral royalties. And it's kind of surprising a lot of times. It's surprising to me that the mineral royalties is as low of a number as it is, $19.8 billion inception to date. That seems like a relatively small number. I mean, 1,980 million, it's a lot, but it seems, I'm sorry, it would be more than that, 19,000 million. Sorry, I missed a zero. But it, in the scheme of things, when you consider that there's been $100 billion of earnings, and we've had $43 million paid out, and we still have a balance of over $80 billion in a fund for a state with 750,000 people, it's pretty amazing. And that's the power of investing, combined with a recognition of a future need of the state. What time am I supposed to be done? Does anybody know?
8:30.
Oh, I've got all kinds of time. Oh, okay.
Lots of time,
Okay.
really do.
Well, I was gonna say I could be done at any time. If people had questions.
Well, but can you talk about the endowment and 2 funds versus 1? Is that part of this?
Yeah, like this concept. And so this slide is intended to depict the current structure of the permanent fund. And so we have principal and we have income producing investments that, as we have gains realized, like I said, not total earnings, but gains realized, that money shifts over to the earnings reserve account, then the policymakers, the elected officials of the day, have to manually decide they'll inflation-proof the fund, and they have to manually decide that they won't spend it all. Because all of the earnings reserve account is available with a simple majority vote of the legislature combined with affirmation of the governor. So the legislature could do something irresponsible if they chose to. And what the proposal that the trustees of the permanent fund have advocated for since, I don't know, 2000, has been to shift to a single fund with a single payout without those manual requirements, so that there isn't an ability to overdraw, and there isn't a temptation of overdrawing, and there isn't a requirement to inflation proof. And a single percent of market value payout would do that. And again, people then, my experience has been people start saying, oh, well, you might invade principal if you start doing that. And well, that's a function of, if you set that draw rate at 12%, yeah, you probably will. But if you set that draw rate at, and I guess back up, what is principal, I guess would be the first question. And does the 14 billion in unrealized gains become like the cushion at the start in somebody's mind? Or is it, I mean, if you look back at GAAP income, we would have been able to sustain a draw along the lines of 4 or 5% during the life of the permanent fund. The fund balance would obviously be a lot smaller because you wouldn't have had those deposits from the, you know, quote unquote state share back into the fund. But you, on a forward-looking basis, and when you look at contemporaries, most of them have a structure that's along this line, from a, I don't know, I don't want to use gold standard, but from just the being able to assure that you're going to have a steady, predictable, and fund that will exist in perpetuity. This model is the best one. And if that could be done constitutionally, which is the hardest to do anything, of course, and probably unlikely, but if you could, it just eliminates the ability of a certain generation to take advantage of what everybody in this room is sacrificed for to some degree. You know, why did you give? I certainly didn't give something up when I was 12, so some guy in 25 or 7 or 30 can get a $100,000 check. I just didn't do that. That wasn't why I did it. I mean, that guy, maybe it's Mr. Seitz, and he's deserving of that $100,000 check, but maybe it's some guy that just moved here last year. Is he deserving of that $100,000 check? Because I gave something up? I don't think so. I think that, I mean, it's just like, why didn't Pauline gets on me about this one too, but why didn't I catch every fish in the river? I'd like to catch them all. It's pretty fun to catch fish. I mean, but you don't, because you know if you catch all the fish, there's not going to be any in 4 years or 5 years or whatever the return expectation is. And so you manage for intergenerational benefit. And it's the same thing with the fund. And this maybe is a dream, but it certainly is the way that you could get to having the most security in your mind that the sacrifices that you've made are going to withstand this test of time. I don't know. And this is the paper that Cheryl referenced, and it is it's an academic paper. It's a little dense at times, but it has a lot of great information from both a historical perspective as well as ideas on how we might evolve as we continue to grow with the permanent fund. And if you haven't read it, I'd give it a shot. If you're tired, don't do it. But I mean, I shouldn't make fun or light, because that's kind of the difficulty of my job in general, is that I feel like a lot of folks don't have enough information to be able to make informed decisions and say, like, I actually don't just want a permanent fund dividend. Everybody wants a permanent fund dividend. That seems pretty universal. Some people are like, just give that up, but don't have a tax. Some people are like, oh no, I absolutely wouldn't give that up because it's critical to me. And so there's this huge variety of views that seem to focus just around the permanent fund dividend. But I think it was former Representative Johnson said that she had a survey that she used to give constituents, and she'd ask them, what was last year's dividend? And I don't know what none, but the majority wouldn't remember, because it's important, but it's not like the end. I mean, for the majority, I guess, of your constituents at least, it wasn't.
It was Senator Bishop.
Oh, was that Senator Bishop's survey? Okay, I misspoke, sorry. I just heard the story from you. Okay. But I thought it was interesting that would be the case, because it is hard to remember what last year's dividend was.
So, Juanetta, before you do whatever you're gonna do, okay, so Deven, if this makes so much sense, and has there been bills proposed in the legislature to accomplish this before?
There have. I think the closest one might have been Representative Groves. It's like a joint resolution for a constitutional amendment. There have been other proposals. There's different viewpoints. Some people, like I said, view this as an invitation to invade principle, and I think it's just because people have a lack of understanding about how institutional investing works. And I don't want to say it, I feel bad even saying that, because it sounds cavalier. And I mean, anybody should be able to understand anything at the end of the day. And so that's on us. We need to do a better job of ensuring that people can say, I get it. I get why this can work and why it wouldn't be an invasion of principle.
So thank you for that, and so I'm interested in what Representative Sadler might say about the legislature's capacity to consider this legislation, and Senator Giesel, and even Carolyn Hall as a candidate. What are your thoughts about this? So, Juanetta, we don't have as much time, so is that all right if we just do this kind of half-assed?
We'll use Cheryl's format.
Okay, all right, so Representative Sadler, Senator Giesel, what's it gonna take for the legislature, even, because in the trustee paper, it does talk about a statutory approach.
Yes.
As opposed to just a constitutional. So what does it take to get 11 and 21?
What does it take? Well, I appreciate the presentation, the detailed it, very much so. This is like the curse of inheritance. It sounds great when you're writing your will, but once your kids have to divide the money, it gets very problematic. So I applaud I've read the trustee papers for years and applaud the idea of POMV. It's a better management tool, but it seems like we kind of went halfway. We still have part of that structure, but the old structure is still there. I think from a legislative perspective, our constituents strongly have an interest in the dividend. Jay was right, it doesn't make people involved in government a small, select, beneficial portion of government. But I think if you go the whole hog and make the entire management combine the accounts, there'd be a transition period where people would be fearful. They like what they get, and they like what they know. And I think it would take an act of some faith of the 11 and 21 who would vote for this and the governor to approve it to make that important structural change. People seem to think the dividend is the be-all, end-all, and that's the first question they'd ask is, what's the dividend? But some difficult decisions were made when the permanent fund was established. If people gave up the opportunity cost to spend that money then, I think it would be beneficial to do it in the long term, but there's just a rocky road to do it. It would take a lot of faith. And it may take a precipitating crisis.
That's probably the most accurate.
Yeah, sometimes things have to get a lot worse before they can get a lot better.
Well, I appreciate that question, Cheryl. First, Deven, thank you. As a territorial kid, it warms my heart to hear you describe why the dividend, why the fund was created and how it's grown because of the sacrifice of previous generations. And that the money isn't to be spent whole hog today. That warms my heart. What I have observed is that the the voracious appetite related to the dividend has waned recently. That people are beginning to understand that we have to maintain this fund and that these massive dividends are not rational. And I believe the legislature has grown in that knowledge and maturity also. I think that elections matter, and what the result of this coming election is will determine how much progress we can make on this important subject of combining funds. There is effort going on. Knowledgeable people have put their heads together to look at how statutorial we might do this. You know, to put out a constitutional amendment, I immediately ask the question, okay, so who's gonna do the education to convince people to vote for this constitutional amendment on the ballot? That costs lots of money and will take a lot of energy. That's just unrealistic. But starting out statutorily, there is significant effort right now, and you will see something on the table, certainly on the Senate side, probably some individual bills, but there's a lot of collaboration to go forward statutorily.
Thanks, Kim.
So Carolyn, I don't mean to put you on the spot, but I am gonna put you on the spot. So are you hearing anything as you go and talk to the potential voters? What do people say to you that you're observing?
Thank you for putting me on the spot. I was not ready for this, but I'm
I know.
happy. Which is probably why you're doing it, but it's totally fair. Thank you very much for the presentation. I'm definitely here to learn. I think, so one of the reasons why I'm running for office is because I'm incredibly concerned about our structural deficit. And I feel my personal view is that we need to grow up as a state and we need to be acting more fiscally responsible. And so I largely agree with what the representative and what the senator has shared, and elections really do matter. And what I'm hearing at the doors when I'm talking to voters, I am actually really stunned. People, they don't care about the size of the dividend. They're really sick and tired of the bickering, and they just want it to stop. Some people have even told me, just set it and forget it, or just get rid of it entirely. And quite surprisingly, but maybe not because of the makeup of my district, but unsolicited, voters are telling me that they want an income tax. And so I do think that there is a sea change here, and we need to take advantage of that, and elections matter. So, thank you.
I'm sorry, I don't have my timepiece is recording. So what time do we have? 8:30. 8:30, okay. Do you have time for a couple of audience questions?
Yeah.
Okay, so there are note cards on your table if you'd like to ask Deven a question, and or I'll bring the microphone to you, however you want to do it.
Since you don't have any written note cards yet, so I'm not jumping ahead of somebody.
You're good, but use these note cards on.
So Deven, I've enjoyed your approach of investment and relating it to a house and house asset. And
But we need to know where that $100,000 house is. What market is that?
But, and as you continue to present here, I have thought that maybe one of the ways of making this understandable, and I have a really hard time making anything understandable to anybody, so I understand the problem, is relating this structure to that house, because your investment strategy for your POMV or for your dividend is you have to keep as much liquid to pay, right? So if we don't have this, we might have to sell the house for the POMV. Have you tried that?
I mean, the POMV, the liquidity issue for the fund is kind of non-existent. I mean, I like the angle, but I don't know that it passes the red face at the end of the day. If somebody were to dig in and look at our portfolio, I mean, we have 1% allocation to cash still, and we generate about $1.7 billion in just regular recurring income that's statutory rents, rents, dividend income, and other current income. So it is Maybe there's a way though. I'm gonna give it some thought.
I look at 2008, when we almost didn't have the cash for the dividend.
Yeah, that was just one of the years.
Exactly, just thought I'd bring it up.
Yeah, and it was statutory net income driven, because if you look, there's one of those charts that shows the balance of the earnings reserve account, and it used to be pretty skinny. And so there were multiple years where it came down to the final quarter of the year and there was a bump in statutory net income that allowed the dividend payment to go out the door. And again, that this move that we've had within the portfolio to maintain return through diversification into more illiquid strategies could exacerbate that, yeah.
Okay, we've got a few questions. Go ahead now. I think you guys can hear me. I usually project. So the first one is, can you respond to the assertion that both POMV and inflation proofing are duplicative of one another, that the POMV essentially incorporates inflation proofing already?
So the POMV is the outflow. And so that's based on a historical average balance, the way that it's constructed in statute. But it's not doing anything to increase the size of the permanent fund principal. It's just, that's the outflow. And if you wanna be able to buy a loaf of bread next year, well, if inflation was 7%, you need to put 7% of your principal balance into the fund. And we're not inflation proofing, by the way, the earnings reserve account balance. It's the principal balance that's being inflation proof. So it's not necessarily even the full fund that's receiving that inflation proofing benefit. But they are definitely two different concepts. They work in tandem, so that you ensure that next year's, as much as possible, obviously the market's going to play a huge role in what next year's payment's going to be, although that's smoothed by that historical 5-year averaging, that you're going to be able to make those transfers into the future, and that they're going to be in line with still being able to buy that loaf of bread.
Great, thanks. Okay, the next question is, given the experience of the 2008 market shock, basically, and relative to returns and your benchmarks, what have you learned or adopted or changed since that to buffer against that kind of volatility?
Yeah, well, we have, I think that the portfolio has evolved a little bit since 2008, but I think that there is still, in 2008, the only use of the fund was paying dividends based on the historical formula, and so it was a much different scenario, and it's much more impactful to your fund's performance if you have a POMV draw like we do now. Oh, sorry. And so if we'd had a 5% draw structure in 2008 and had to make that payout when the market dropped, it would have exacerbated the problem, and it would have made that dip deeper and more difficult to claw back out of, because we wouldn't have had those assets in the pool. And so in some ways we're more exposed, not less exposed, to a crash like that. And just because the nature of the game, once you start drawing a larger amount from a chunk of money, market volatility has a more profound impact. And so our chief risk and compliance officer did an analysis, I think in February is when he presented it, and he modeled different portfolios and what happens when there's market dislocations. And so the 80-20 portfolio, so a lot of folks are like, why aren't you more heavily involved in like public equities? Why do you even have a fixed income portfolio? Like I said, it's kind of at the bottom there is the foundation, but the returns are pretty austere. It hasn't, and it's had some negative experiences. Interest rates went up and down, but his analysis actually found that the fixed income component of a portfolio at an 80-20 basis, 80% equities, 20% fixed income, resulted in a higher IRR, internal rate of return, than if you just had a full equity portfolio, because that volatility of equities results in less ability to claw back when you have the dips. And so it's kind of counterintuitive, but there are aspects of the portfolio that would provide some moderation to a market crash like we experienced, but that was so all-consuming. I don't know, I mean, it was a bad time. When you start losing financial houses that have existed for 100 years, it's not good. Lehman Brothers, I mean, Bear Stearns, and B of A would have, B of A bought Merrill Lynch. Merrill Lynch would have gone under. Citi, their stock broke $1. They were gonna go under. If it wasn't for TARP, I don't know, Goldman, Citi, all those they were all in trouble, big time. And Goldman got out early. They were kind of ahead of the curve. I mean, if something like that happens, all bets are off a little bit. It's just extraordinary times.
I don't know if you saw the HBO movie about that. I can't think of the name of it, but the tail twisting that went on behind the scenes, at least the way that it was portrayed, was.
Yeah, we were trying to
pretty
price
shocking.
bonds. We were going to do. I don't want to bring it up. We were going to sell pension obligation bonds in 2008, and that fell apart. We didn't do that. We were going to.
Agencies were blowing up.
Oh yeah. Well, and bond insurance blew up. Yeah, that went away. We were also going to price the Goose Creek Correctional Facility we tried in December, and we couldn't hit the target lease payment that the legislation limited us to because interest rates spiked too high. So we had to, that was the only failed pricing I ever had. It was a tough time.
Well, maybe a little along the same lines, Deven, has the corporation done any economic modeling to quantify the probabilities of the earnings reserve being depleted over a certain time frame?
Definitely, yeah. No, we've done that. Our chief investment officer, our chief financial officer, and our external consultant, Callan, have all created models that have been presented in the course of the last year. And so they have different, the CIOs is based on historical trends that have been experienced in the past and extrapolating those into a future projection. Some are probabilistic in nature, and they all result in a probability of the failure of the ERA being able to make the POMV payment at the beginning of a fiscal year, whether or not that would within the next 10 years. And so it's going to take, in my view, it would take an extraordinarily negative market for that eventuality to be realized, and I think there are some levers the legislature could pull. Like you said, a crisis creates a lot of momentum, and so that sometimes is what's required to make change. And so like that war chest of unrealized gains, if the legislature changed the definition of what is income, I mean, then if income is not realized but GAAP income, that in of itself provides a safety valve for the ability to continue making the needed transfers from the permanent fund. So there are levers to pull, and I think the policymakers would be given opportunities to take corrective action, because it's beyond what, I mean, all of this is just kind of us wanting to be good state citizens, but our mandate is to maximize risk-adjusted rate of return. Not to worry about whether or not we make a POMV transfer to the state of Alaska. And so we don't manage to that. We're just managing to maximize risk-adjusted rate of return. But we don't operate in a vacuum, so here we are.
I'm reminded of a presentation that Ralph Townsend with ICER made 4 or 5 years ago to a fiscal policy study group that basically looked at the possibility of the earnings reserve account being depleted, and the circumstances where he said it was most likely was where if we had a 1970s version of stagflation again, and certainly during the last couple of years, that presentation keeps playing over in my mind, that we've had this crazy period of inflation but now wages are seeming to come along, and maybe it's correct, the market is correcting, but definitely a conversation, a presentation that has replayed in my memory a little bit the last few years. So worried that we might be headed into that very kind of scenario.
We're up and to the right.
Up and to the right. Always good to hear.
No, I mean, that is kind of, I mean, I don't mean to paint a negative picture. I think people should just be aware that there's potential probabilities, and that we should be prepared and poised to take positive action. And to the extent you can do something that, in my view, this type of change, whether it was statutory, that's a little less durable, obviously, because then it's just a statute. It can be changed by a future legislature rather than the people of Alaska being involved directly. But either way, I mean, if you could get to a constitutional amendment, it would be the item of legislation that when you were talking to your grandkids, you're like, oh yeah, that was me. Just like, just like Jay Hammond or whatever, Hugh Malone, like, oh yeah, that was me. I was Speaker of the House when they created the permanent fund.
Yeah.
You'd be the one that like protected the permanent fund in perpetuity. I don't know, that's.
Well, next week I'm getting ready to make my annual Facebook post. Thank you to Hugh Malone, Jay Hammond, Oral Freeman, definitely some lions in state leadership that helped make today possible. So with that, I'm going to say thank you. Cheryl, do you have some closing comments? Yes?
Okay. In the past, Commonwealth North has taken a position in support of an endowment. I'm channeling Eric Wolforth right now, who was our fiscal policy study group co-chair. And so we're going to revisit that. We're going to review what we did in the past, and I anticipate with Jennifer's work too, we're going to bring forward to the Commonwealth North Board another positions, resolution, etc. So we would like to continue to be engaged in this important discussion. So we're here to help. And so if anybody here would like to participate, let me or Jennifer know, and we'll keep you posted on steps forward. So thank you for joining us this morning. And thank you, Deven.
Yes, thanks again to Deven, Pauline Swanson, also with the Current Corporations here, and has been helping with this presentation today. And just again, a reminder, thanks to our program sponsors, Alaska Communications and ConocoPhillips Alaska. And I invite you all to join us on October 22nd for the Hickel and Egan Awards at the Denina Center. And we will be recognizing Senator Dan Sullivan and former Governor Bill Walker with the Hickel and Egan Awards, respectively. So please come and join us in celebrating the leadership and public service of those two individuals. And with that, good morning, and hope to see you again soon.